I've been suggesting recently to folks, maybe you should be gifting while you're alive so you can see it being used.
95% of kids really don't want anything to do with this money. They want their parents to be around.
Every time we had family gatherings, every opportunity that I have had to talk to someone older than me, I always try to take that opportunity because you always learn something you didn't know before. I'm going to say something controversial. Hopefully you guys will invite me back.
Welcome back to the Personal Finance Project. Scott and I are joined once again by popular demand by Moe Allain. The topic of today's podcast is not an easy one, but we have regarded it as essential. It actually came up during our conversation covering long-term care, which was the last time Moe was on the podcast. And so today we hope to get into what we think parents ought to discuss with their, in most cases, adult children before they pass away. Now, we hope that this isn't going to be an episode about complex estate planning strategies or the finer points of probate, but rather more of a conversation of the sort of high-level topics that parents might want to discuss with their children. We think that parents have an obligation to provide their children with some clarity and some organization within their estate, because this can frequently lift the burden that the ones that we leave behind are left with in the event of our death. So, Mo, let's begin this episode by just saying, if you've got adult children and you're trying to get some semblance of an estate plan together, where might parents begin this discussion?
I think the first place that parents should begin is to let their kids know that everyone needs an estate plan, regardless of the size or lack of size of your estate. I think that is the first place to begin, because if they don't realize they need an estate plan, they may not listen and go forward from there. So the first thing is the realization that everyone needs an estate plan.
And I think that this would then introduce them to the topic and say, okay, everyone needs an estate plan. Mom and Dad, you seem to probably then have one. Where do I figure in as an adult child? Maybe I'm not the only child. Maybe I'm the fourth child, as it turns out. So are there certain key players in an estate plan that we might want adult children to be aware of?
Well, sure, absolutely. I mean, if they are a part of their parents' estate plan, for instance, either whether that be an executor, a power of attorney, a trustee, they need to know what their roles are in that plan. And they probably should have a copy of those documents as well. I think that's a really, really important thing, because oftentimes, you guys have seen this, Scott, you and Greg, you're reviewing an estate plan for a client, and you look at things and either there's a minor child listed, there's someone who's deceased. Well, that's not a very good estate plan, right? So then if someone is indeed listed as, one of those particular positions, they need to understand that they are in number one. And number two, they need to understand what that means. I think so many times people get put on estate plans. They're either the oldest or the closest, okay? Mm-hmm. And oftentimes that may not be the best decision. So they need to understand that, what it entails.
Yeah, and I would say along those lines, just because you're the executor does not mean you know what that entails. And so some conversation or, hey, you should probably look up what it takes to, say, probate a will in the state of Texas, mm-hmm. or these are the accounts that we have, and therefore these are some of the custodians that you'll be responsible for dealing with, talking to, making arrangements to get these assets moving from the estate level down to the beneficiaries.
And I think one of the notes that I made in terms of, there's a willingness element to this, but there's also an ability to execute on this. And I think I'm probably lacking in both of those departments. But as far as getting your estate organized, I think one of the kinder things that you could do to your adult children or for your adult children is to have some sort of centralized document or a book of documents that basically walks them through the who, what, when, where, why, how of the estate. And so I think a digital copy as well as a physical copy is probably a good idea, just because many of these things can be lost. And that might include things like a will that you review with your children annually. And maybe if there's parts that you want to leave out so that feelings aren't hurt or whatever, that would be to the parent's discretion. Trusts, if they're going to be trusts, how the property is titled, how the accounts are titled, IRA beneficiary designation forms. I feel like that's something we ought to be reviewing with clients at least on an annual basis. Insurance policies, birth certificates or passports if necessary, passwords, because everything now with banking is online. I think that these are sort of the elements people fail to consider. It's like, well, we can't even log into dad's Chase bank account or wherever because we don't know the password. And now he can't tell us. So do you feel like that's probably a necessary element or something parents could do?
Absolutely. I think part of the issue is the kids not really understanding that they need to know this. And I think that if someone has multiple children, each of those is going to feel differently about how much they want to get involved in this. You always have that if you have 3, 4, 5 kids. There's always one that's interested that wants to do things. And the strange thing about that is that they may not be the most capable, but they may be the most interested. Then the most capable may not be the most interested. So this is one of those things that's really, really important, I believe, when you're working on the estate plan. But I concur. I mean, I think sometimes I've sent my daughter a summary in the form of a PDF first, in addition to having the hard copy in my safety deposit box and in my strong box at the house.
Okay.
So we've got it in multiple places. Of course, those things can change, right? Passwords can change. So, you have to continue to update it. Otherwise, the information you've provided to them is not very good.
Yeah. I mean, Scott and I were just having a conversation with one of the estate planners within Baird talking about the problems of over planning, where you can make some irrevocable choices and then the tax law either changes or doesn't change. And I think one of the things that we've seen is the elimination of the stretch IRA through a lot of estate plans kind of out the window, where they had anticipated beneficiaries to be able to distribute these assets over a very long period of time. And then all of a sudden it thought, well, actually, it might make more sense for us to leave our IRAs to a charity and leave all of our after-tax assets to our children. So I think some annual reviewing of the will of your kind of estate plan is certainly something parents ought to do.
Yeah. Oh, go ahead.
No, I was just going to say, the other thing is we were talking about the fact that everyone needs an estate plan. Well, for someone, maybe they're younger starting out, they don't have a lot of quote assets yet. Maybe their estate plan is basically making sure they have the appropriate beneficiary designations on their 401k plan through work, and that's it. But that is an estate plan for that individual.
Yeah. I was going to add to that maybe part of the estate plan is, joint tenants on a bank account, or TOD on a bank account, so that, maybe you don't have so many assets that you absolutely have to have a will. Maybe you can kind of do everything through beneficiary designations and a TOD checking account, something like that.
And maybe also explaining to the degree that they can, or having them work with the financial advisor saying, why are my accounts held tenants in common? What does that allow us at the death of one of the tenants? And often in this case, it's one of the spouses. How is that different from joint tenants with rights of survivorship? Are there things that we're overlooking? Are there any tax differences? And I think that is why maybe introducing adult children, you can comment on how you feel about this, bringing them in to one of the annual reviews so that they can develop a relationship with the financial advisor, so they can all get kind of on the same page as to how the assets are titled, where they're held, and how they'll pass along.
I think that's incredibly accurate and helpful. Recently, I did a Zoom call with a client in their early 80s, just got diagnosed with Parkinson's. 4 adult kids, live all over the country. So we did the time zone, ring around the chairs kind of a thing.
Naturally.
We got that set up, and it was amazing. They wanted me to provide everything to the adult kids. They were asking questions they never asked their parents about all this stuff. It was pretty interesting and amazing. And the thing about it is, the ones in charge did not know they were in charge. The parents hadn't told them yet. And I was fussing at the parents after the call. But anyway, those are things they need to know about and ahead of time. But now they put a name with a face of someone that knows everything about their parents should something happen to them. And, Parkinson's doesn't exactly enhance your longevity. So it's one of those things that, kind of was a red flag as to, what, my kids need to know what's going on.
One other thing I'd add on that subject of saying, the kids don't know what their responsibilities are. Another thing that I've noticed over time is that if you are doing something that, I'm going to just say, not as questionable, but is not in line with, say, just a split between the children, as an example, like say you are giving little Johnny an extra $50,000 to account for something that happened along the course of the kids' lives,
Sure.
it might make sense to explain it. And whether that's in the will or just in maybe a note to the heirs at some point, because I've run into some situations before where you get to the end, it's never been discussed why the split is not equal. And then there's hurt feelings, in the aftermath.
Yeah. And Mo, as a fellow parent, I'm sure you've used this line many times, which is fair is not equal and equal is not fair. And I think as we see kids develop different skills, different abilities, different tracks in life, that's a really great point. Because some kids invariably are going to need maybe more financial support than others. Some might not be able to handle their money as well as we would hope. So they might have a situation where actually you're going to have a corporate trustee on your trust and the other kids are going to be the trustees of their own trust, which just essentially, for the benefit of the listener, gives them kind of full discretion over the distribution and use of both the income generated by those assets held in a trust and the principal. Whereas if you've got a corporate trustee, you might have a little bit more difficulty, especially if the parent has put like a spendthrift provision on the trust. And that will redound to the kid's benefit. But I think, Scott, you're right. They need to sit down maybe one-on-one with that child and explain their thinking and maybe update that as the years roll by.
I mean, in the back of their mind, I'm sure they know.
Oh, yeah.
It's still nice to just kind of have that clarity of, okay, because of this thing that happened or this concern about the future, maybe a potential divorce that could be looming, something like that might be a reason why you do something a little bit different.
Or just a worry about it,
Yeah.
Or just the taste too, because you could imagine an estate that's got very disparate assets, some of them purely financial, stocks, bonds, mutual funds, but maybe there's property. Maybe there's a vacation property and one of the children or some of the children, they're not interested in ownership or joint ownership with their siblings in that property at all. They don't want to take any part of it. So maybe rather than going about the difficult business of getting an appraisal and selling the property and then distributing the cash, you just say, well, they don't want to share in the property, so we're going to give them more stocks, bonds, mutual funds, far more easily divisible than an actual piece of real property. But I think disclosing that ahead of time so as to not create a bunch of confusion when we're probating this will, I think is a great kindness that the parents could do their children.
I'm going to say something controversial. Hopefully you guys will invite me back. But one of the things that I've noticed is people apparently believe that there is this rule that says that I have to give each of my kids an exact equal proportion of everything that I have when I'm gone. There is no rule to my knowledge, maybe you guys will correct me on that, saying that that is the case. And I think that sometimes parents work so hard to make that happen that they lose some of the goals and the impact in the translation.
Mm-hmm. And I think you're right. I think you don't want to lose sight of what the goal of the goal is. Because I think the immediate goal would be, I want my kids to feel like they got a fair shake. But the goal of the goal is to actually have it be a fair shake and to acknowledge that kids are going to have disparate abilities, disparate needs. Some people might marry into a family that's quite wealthy. That happens from time to time. And then maybe the inheritance that they get is not going to be very large as a consequence of that.
Yeah. And another point on that is, the goal of the goal, until you're very, very much on the precipice of passing away, the goal is to take care of yourself. And that's something that we talk about to retirees all the time, is that 95% of kids really don't want anything to do with this money. They want their parents to be around.
Mm-hmm.
So, if we think about, all right, what's the best way to communicate some of these things is, ahead of time, but understand that this is for you, and the kids are going to be so grateful for what they get in the end. In almost every case, don't worry about fairness as much as taking care of yourself and having that relationship that's the lasting memory, as opposed to some financial consideration.
Yeah, I mean, I think kind of like in the airline, warning ahead of the flight, you got to put your own oxygen mask on first before you can help your neighbor. And that comes, and I think we counsel clients through that all the time, which is like, look, you don't want to make your legacy goals the primary goal, because if you run out of money ahead of when you pass away, there is no estate to begin with. So our investment philosophy should be developed around meeting your needs and wants in your retirement. And then if there's some stuff left over that's going to go to the kids, I think, Scott, as you mentioned, in most cases, the kids are perfectly thrilled that there's anything there for them.
Well, and as a final thought on this, in the podcast with Richard, we talked about this, that if you get to playing the game of just adding zeros to the end of the balance, and that is the complete focus, you're just not going to have a real good time in retirement. It's just not going to be a lot of fun for you, maybe the people around you. And then you leave this massive estate and people are disenfranchised with you because you're a miser. I don't
Right,
know.
yeah.
It might not be a real fun place to be.
Well, I mean, it's certainly possible. And Mo, you might have had interactions like this where kids have come into the money and they're visiting with you and they're like, man, why didn't mom and dad spend more while they were alive? Why didn't we go on more trips as a family? Why didn't they do some of this stuff? And you can see how a person like you're saying, Scott, could totally err thinking they were doing their children a kindness by leaving them some fairly cold financial assets, which are appreciated. I don't want to sneeze at that at all. But lifetime experiences, I think, and the memories made are far more valuable to many children than just the money they get.
You hit on something that I was going to talk about real quick, and that is the idea of giving with a warm hand versus a cold hand. And, the idea of that memory dividend.
Mm-hmm.
Okay.
Bill Perkins.
The memory dividend. And that's the idea that, your relationships are the most important thing in life. And, it is okay. And actually, I've been suggesting recently to folks, maybe you should be gifting while you're alive so you can see it being used. Okay. Whatever it's for, house, business, to educate a grandkid, whatever it is, kind of a thing, in doing that. But absolutely, I think that's, there are options. Here's the thing. It's their money. They can do with it, with those assets, what they want to do with it. So, think about it. Don't do what everyone else is doing. Everyone's situation is completely unique.
Well, we've talked about this before, and I called it the happiness dead weight loss, which is like when you give with the warm hand, not only do you have the experience of being charitable, generous to a loved one, that in and of itself is going to provide, like you've talked about here, memory dividends, where you're going to look back on that generous gift. And if it's used appropriately, you're going to get a nice hit, a warm, fuzzy feeling just thinking about that. And then not only are you going to do that, but the person that you're giving it to, they're probably at a stage of their life where they're going to need it a lot. So you think about the cash flow needs for a person who's in their early 30s and maybe has an irresponsible number of children, they're high. And so if you're talking about an inheritance that's half the size in your 30s to what it would be when you're in your 60s, the present value or the utility of that might actually be much higher to that person who is cash flow strapped in their early 30s, getting their family off the ground, than they are when they're nearing the retirement of their own. And so you provide some happiness to the receiver, I think in excess of what they would get if you gave it to them with the cold hand. But more importantly, you get a hit of happiness, and all of that is lost if you give with the cold hand as opposed to the warm. So I think that that's a great idea. Some, for whatever reason, people seem maybe slightly averse to it because they think their children might develop a dependency on an annual gift, or they might start to come to expect it. And I suppose I could appreciate how a person might feel that way, but I do think it's worth the risk.
I think there's a second part of that. I think that it's our responsibility as advisors to let them know that if they're doing this gifting with a warm hand, they're going to be okay.
Yeah.
In the back of their mind, I do believe that people do worry about that. And we have to tell them, it is okay. You have permission to gift while you're living. To do that inter vivos gifting. You have permission, so go for it.
I like that.
And Greg, on that note that you just made, I think if somebody is concerned about like, oh, well, am I creating dependence, or am I giving them things that I'm providing them with stuff that they don't need right now. Well, to use the phrase, if you get hit by a bus, they're going to have all of it right now.
Yeah.
So if they can't deal with a little bit of money today, they're probably going to struggle with a whole lot of money tomorrow.
That's true. That's a very good point. So I feel like if we can distill down some of the colder parts of estate planning, which is a centralized location that everybody's aware of, maybe a digital copy of some of the estate planning documents, maybe not the full will, maybe you redact some of it, like Scott was talking about, to allow for those one-off conversations about here's why you're getting this and your siblings are getting that if you're in a multi-sibling situation. But definitely a hard copy of the will, physical, digital, in a safe location, update that annually, have the conversation about passwords, bank accounts, insurance policies, all the rest. But When we came to you for this episode, I think what you're particularly...
Craig, can I interrupt you for just a second? So
Please.
One of the things I was going to add to that is I don't know what you and Scott do with clients, but we kind of require all of our clients to provide us with a digital copy of their will, powers of attorney, HIPAA, medical directives, if they have trust, so that when calls come in, well, number one, so that we can find out who the important people are.
Right.
Right. So when they reference Bobby or whoever it is, we know what role they have, and we can suggest, well, we probably need to get to know these folks sooner rather than later, particularly once they get to a certain age, have a particular diagnosis, et cetera, et cetera.
So just knowing the people. I mean,
knowing the people.
Yeah. And you're right. I mean,
people anyway. So
yeah, it ultimately will be, because these are going to be the people who make the decisions. So I think all of those sort of like logistical building blocks are extremely important. We can't overlook those. And that, I would say, is the science of estate planning. It's coldly rational. It makes a lot of sense. You're going to want to talk to the accountant, the attorney, the financial planner, whomever. And you're going to want to know where these documents are and who has the powers over what parts of the estate, so to speak. But in your outline, you kind of took it slightly a different direction. And there's maybe some things you might discuss with clients that is sort of more the art of estate planning, which is not necessarily the facts and figures that you want to pass on to your children, but the wisdom. Investment wisdom, life wisdom, investing philosophy, why it is that you conducted yourself the way that you did, why you've invested the money the way that you did, how their children might go about investing money to be successful maybe as much as they were. So what were some of the topics that, talking to, you have children, I have children, if there were lessons that you might want to impart before you were to depart, what might those be?
So how much time do we have?
Well, I think let's just see where it goes.
Well, I think, one of the things that I would tell people would be, success and building wealth is made in the margins. Okay. It's not made 9 to 5. If you're doing what everyone else is doing, you can expect to be average. That's all there is to it. I've told my kids, save 25% of every dollar that you earn. And they're like, well, that sounds like a lot, Dad. And I'm like, if you do that, you'll never be poor. That's, a really important thing.
Well, I mean, I think just distilling it down to telling your children how happy or how financially successful you are will grow in direct proportion to the size of the wedge you can drive between your income and your expenses.
There you go. Well, of course, yeah. Spend less than you make, in other words,
right?
Greg.
So it's like,
that to make
yeah.
sense.
I mean, it's funny because I think very simplified bits of advice are actually undergirded by some sophisticated knowledge, and that does sound like a really simple bit of advice. Don't spend more than you make, and yet we are plagued by people who have yet to grasp that.
Well, I mean, it's very true.
Yeah.
Well, and as a part of that, you've got to build in invisible walls. You've got to make things automatic. Okay. It has to be consistent. If it doesn't feel boring, you're not doing it the right way. It's not supposed to feel exciting. Okay. If you want excitement, go to Las Vegas.
Yeah. Well, and I think on that 25% rule that you were kind of just suggesting there, Mo, and one thing I would say is that, it's a lot easier to start at 25 when you're not making much and then continue it as you go forward than to start at 7 and then you start making a lot more money and bump it up to 25. I mean, then every dollar plus some, has to keep going to the savings. And when you start making more, you're going to want to do some things. You're going to want to have a little bit more fun, travel a little bit more, maybe get a nicer place. So if you start at that higher savings level and then just continue it as you continue to make more, that's going to be so much easier from just a discipline standpoint.
And here's one that I'll steal from you, Mo. You have a quote here: habits eat good intentions for breakfast.
Live by that one.
And actually Hannah and I, when we were leaving just the other day, we're talking about how we regard contributions to a 401k as an elective deferral, because that's the only way you can get money into there, as different in our mental accounting than we do having received the money and then now having the option to go to Target or put it in something eminently practical like your Roth IRA. And so you can construct your budget knowing that you've put 25% of your income, which I would admit, pretty high, into your 401k plan. Well, then you're right. Now you've built that invisible wall that prevents you from ever considering that money as an option for consumption unless, of course, you want to go about the business of dipping into your 401k, something we would be adamantly opposed to. And I think that you're absolutely right. Once that habit is established, because a habit can only be improved once it's been established. So establish it at, I don't know, Scott, $100 a month to begin with, something that you can live with, just knowing I am casting a vote, in the vernacular of James Clear, for the kind of person who is going to finance my retirement early and often.
Yeah, and I would just add to that, oftentimes when folks are out of college and they start their first job, they have a tendency to procrastinate getting enrolled in their 401k plan.
Oh, it's a huge problem.
So most 401k plans that I'm aware of have some kind of a matching mechanism. Well, if a company is going to up to, let's say 6%, match 100% of what you're contributing, what people need to understand is that you can put in that 6%, you will get 100% rate of return, and your spendable money will go up simultaneously, all at the same time. Did you guys catch that? You get 100% return, your saving and your spendable money goes up all simultaneously because it's a before-tax contribution.
Mm-hmm.
This is something that's lost on so many younger folks, and we've got to communicate to them. Sometimes we have to go as far as making a copy of their payroll check before they start that, and then after showing it and then circling it and saying, "Here we go." And of course, there's a big educational gap.
So as people who've listened before probably know, I'm a bit of a Roth skeptic. So I like what you said there about just getting in there, bird in the hand of a tax deduction is better than, moving it to your joint account or your bank account and then trying to figure out what to do with it. Get that tax deduction now, get the money into a plan. I also really like what you wrote here about compound interest being the eighth wonder of the world. Because if you get those habits in place by the time you're, say, saving you do from, say, 22 right out of college to 30, that is the absolute most beneficial saving that you're ever going to do. Yeah, you're going to be making more money later and finding other things to save into and invest into. But that first maybe 8-10 years, that's the ball game for compound interest.
Absolutely.
I've told son, daughter, and their friends all the time, and as often as I can, I'll still say it. Are you afraid that you're going to have saved too much money by the time you turn 45 or 50? And they're like, well, no. I'm like, okay, well, so do what I'm telling you to do. Okay, because here's the thing: you can slow down later in life. Okay, and life will slow you down too, by the way. Okay, has a tendency to do that.
We walk our clients through that all the time.
So do it aggressively while you can. Get in the habit of doing it, okay, and keep those habits going. And as Scott was saying, that compound interest, consistency, and boring, that's what does it. And it's not really that fancy. It doesn't take a rocket scientist, and I know that we all work with those kind of folks.
We kind of do.
It doesn't take that type of activity, but you have to have patience too, and just let it do what it's supposed to do.
And I was just going to say, I think that what stands between you and a great life is not your 401k contribution. If you're constructing your budget in a way that doesn't allow for a 401k contribution, you feel like you couldn't part with $200 or $300, $400, $500 a month, then we maybe need to examine your lifestyle a little bit more closely. Or we maybe need to think about how much value are you putting just in the money, just in the cash flow. Because if that really is going to make all the difference in terms of what range of experiences that you might have, and I don't think any of us are advocating for austerity in your 20s. Because I think life can be really exciting in your 20s. A lot of people are out on their own for their first time. They have their own job. They have their first job. They might get married. They might buy a house. So I'm not advocating for austerity. And I think to Scott's point, if you just save a little bit in that decade between when you turn 20 and when you turn 30, it's going to have a future value that would blow your mind in many cases.
And I was just going to say, on the note of compounding, just this last weekend, Mr. Warren Buffett, who's largely thought of as the greatest investor of all time, announced that he's kind of stepping back from the day-to-day. He's still going to be the chairman, but not going to be the CEO of Berkshire Hathaway anymore. He's an amazing investor, but a huge component of his returns is that he was consistently investing in good companies 70, 60, 50 years ago. And those investments grew, compounded, became new investments that led to the massive enterprise conglomerate that company is today.
Yeah. And if you chart Warren Buffett's net worth, a huge, huge portion of his net worth is actually accrued after he turned 60.
Parabolic.
So yeah, it's not like he was doing, it's not like he was running into financial difficulties ahead of when he turned 60. But if you looked at actual dollars accrued in terms of returns earned, and this is something we counsel clients through all the time, a 6% rate of return on a $3 million portfolio, particularly if you need to spend some money, is vastly different than that same 6% rate of return on a $500,000 portfolio. And I think compounding is really what demonstrates that. Warren Buffett was accruing. And then even if returns got a little bit more modest in terms of how much just dollars they generated, he accrued a huge portion of his total net worth after he had turned 60.
And he's been in his original house for how many years?
I don't know. Forever, I think.
I think like 60 years plus or something like that.
And he did live in some austerity, And I think it's because he was actually doing something that so consumed him that all of these ancillary things were sort of ancillary, So
sometimes, and we have clients that are like this, and maybe some of their kids are like this. Some people are just different cats, if you want to call it that way. I mean, if the most important, if what you get joy from is managing your money to a larger number, we're not here to impugn you for that. But if that's not what you enjoy, but you're doing it anyway, then maybe there's some course correction and some adjustments to make.
Yeah, and I think you had mentioned this on a previous podcast regarding your investment philosophy. It's like you got to be true to yourself. So if and maybe that would be one of the bits of advice you could give to a child, certainly well ahead of when you passed away, is you're going to want to structure your life so that you can live the life you actually want to live, not the life other people are expecting you to live. And I think that's a really difficult thing, and it's one of those trite cliches, but they've become trite and cliche for a reason, is that there's probably a nugget of gold embedded somewhere in there. And I think one of the regrets of the dying is I wish I would have lived a life that was more akin to who I felt like I really was, rather than trying to live my life, trying to conform to the patterns of the world, do what others expected I do.
I'm really big on goal setting, okay? So one of the things for me that I've taught my kids and their friends anytime I can bend their ear is the importance of written goals. And now putting those written goals into their smartphones. Okay, there should be no excuse for someone to not have goals that they can look at every day. And I think by doing that, that can refocus them on certain things and not get distracted like many of their friends are. So I think that leads into that as well.
Yeah, I see that you've put in here set written goals every year during the holidays. It's a fun time to be setting goals while you're stuffed full of turkey and all the rest. Yeah.
But you have to think about this, okay? During that period of time, there's generally a lot of emotions going around too.
Uh-huh.
And that makes you think differently about setting goals. That's why I do it in the holidays before.
I think it does. And I think that you can gain some real clarity at the end of the year when you're reflecting on how that year went, if you've moved yourself forward in the ways that you want to move forward.
Exactly.
And so ahead of when, January 1, it's going to dawn, often cold and gray in Houston, that day is coming. And if you're going to want to be a new person, your intentions, like you said, they don't matter. The words you spoke, they don't matter. But if you can actually adhere to your written goals, not just in word, but in deed, where you can begin doing, however small that first step might be. And I think a lot of people don't pursue their goals because they have to break it down to a first step that's so trivial that they're almost embarrassed to say it. Like, my goal is just to drive myself to the gym, not even to work out. I just want to drive there, get a sense of where the building is, see what I feel about it, and then maybe that's all they can do on the first day. But I think what you talked about before, your habits become the person that goes to the gym. It begins with getting in your car and driving there.
Absolutely.
I suppose you could walk, Greg.
You could walk. You could be the kind of person who just takes, or just setting your running shoes out. I mean, there's a lot of stuff like that in life.
One of the other quote bits of wisdom I would tell people before I go would be, we live in a time when it's challenging to maintain physical and mental health. So you have to develop a system, a routine that works for you, that's portable, okay, that won't add additional stress to your life. And sometimes that might be easy, but it is doable. It absolutely is doable.
I was going to say another one of the ones in here that I thought was gold is find a mentor older than you who has already been where you want to go. And this is actually something Scott and I talked about on a previous podcast, mistakes people might make in their 20s and 30s. which is there's an immense power in surrogates, is essentially saying you think you want to go into, I won't mention investment banking, actually. You might want to be a lawyer. You might want to be an accountant. You might want to be a financial advisor. And you might think that all of these jobs that are offering high pay after years and years of grinding, maybe not so much in financial planning, although the washout rate is pretty high, maybe you can dance perfectly through this minefield and never run afoul of any of the pitfalls, never end up in a place where you're totally burned out, wishing you had done something different. You don't need to interview anybody who's done it before. You can do it all on your own strength. I think that's a huge mistake. I think the best information could be, hey, Scott, you're a financial planner. How did this work? What did you do? Where did you get extremely lucky where I might not? And where did you work really, really hard and do things that I probably could do?
You know, when I was growing up in South Louisiana, my mom used to tell me when we'd have family gatherings, I want you to go over there and talk to your aunt, whoever, and I want you to talk to them. They're not going to be around very much any longer. And it took me a while to figure out that what she was trying to instill in me was they had been around a lot longer than I had, and they probably knew quite a few more things than I knew. Once I got that, every time we had family gatherings and every opportunity that I have had to talk to someone older than me, I always try to take that opportunity because you always learn something you didn't know before.
Yeah, and I think, Greg, to build on that point you had a second ago about how you got lucky, find out what is repeatable, because there's aspects of, say you're looking at a mentor who's been super successful in your line of work. Some of it is going to be repeatable, where you could do the same things that they did and get some semblance of success from them. There might be aspects of it that are just completely in left field, and there's no way to kind of plan your life around that.
Right.
But there are, maybe it's discipline and habits, or the way you talk to people, the way that you think, that you can mold yourself into and do better. I mean, I've been working with Richard, our senior partner, for 12 years, and at the very, very beginning, I tried to be him. I tried to say the same words that he said and say them in the exact same tone. And I realized over time, you can't repeat everything, but you can repeat the structure. You can repeat the way of building a strategy. And then, as you kind of make those things your own, that's when you really find success.
Just piggybacking on what Scott was saying, when I was really, really young, my grandfather used to tell me, if you want to learn how to be successful, read about successful people. So I got into this reading about biographies, right? And I've read lots and lots of biographies. And I think that's a good way to replicate what Scott was talking about, because you do see patterns after a while of things that, I can do that. No, I don't have a PhD, or I'm not an attorney or a doctor, or I'm not Einstein, but I can do some of these things.
Yeah, I can show up when I said I'm going to show up and do the things I said I'm going to do. That's for sure. And that puts you ahead of like 90% of your contemporaries.
Absolutely.
So, or the other thing from reading biographies you get is like the Charlie Munger quip is, I just want to know where I'm going to die so that I never go there, which is essentially a lesson in here's how not to do things. And I think that's an important element of life too.
Greg, you mentioned something important too, is the idea that in our society today, people are so afraid to make mistakes. Okay. I've always told my kids, okay, I want you to make as many mistakes as possible as soon as you possibly can, because guess what? Once you make them once or twice, you're not going to do it again. So the sooner you make those mistakes, the sooner you figure out you made the mistake, the better off things will go going forward.
That was another one I hope we were going to get into. So as we're bringing this in for a landing, Mo, I just had to say that there were two here that definitely pulled on my heart as a parent. It says, don't forget to have fun, because I think that if you are too serious all the time, even in serious endeavors, it's very easy to lose sight of just having some fun. And that would be some wisdom that I would want to impart onto all of my children. And the last one, I'm proud of you for who you are, no matter what. I think that if parents can tell that to their children, even if they're going through a difficult period of life, even if maybe they're not necessarily doing the things we want them to do, even if we don't like them at that point in time, we do love them. We are proud of them just for who they are.
Amen.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.